Most people think higher gas prices are a consumer problem. You pay more at the pump, maybe adjust your driving, and move on. But for businesses, it's something very different. Because when gas prices rise, it doesn't just stay at the gas station. It spreads across supply chains, across industries, across the entire economy. And in 2026, that ripple effect is becoming impossible to ignore. So the real question is, why could higher gas prices hit almost every business in America? Because this isn't just about fuel. It's about how the entire system runs. Let's start with the most obvious layer: transportation. Every product you see around you has been moved. Raw materials, components, finished goods, they don't just appear, they travel. And most of that travel depends on fuel. Trucks, ships, planes, delivery vans all rely heavily on gasoline or diesel. So when gas prices rise, the cost of moving goods rises immediately. And here's the key detail: products don't just move once, they move multiple times, from supplier to manufacturer, from manufacturer to warehouse, from warehouse to retailer or customer. At every step, fuel costs are involved. So when gas prices go up, those costs stack on top of each other. That's the first major impact. Now let's move to the second layer: supply chains. Modern supply chains are built for efficiency, not for high fuel costs. They often stretch across long distances, parts sourced globally, products assembled in one place, sold in another. That system works well when fuel is relatively stable. But when fuel becomes expensive, long supply chains become a liability. Because distance suddenly has a cost, and businesses start feeling it. Shipping becomes more expensive, delivery times can change, margins get squeezed, and companies have to decide how to respond. Now here's where things get complicated. Businesses can't always just raise prices to cover these costs, because customers are also affected by higher gas prices. When people spend more on fuel, they have less money for everything else: retail, dining, services, travel. So demand weakens. Customers become more cautious, more selective, more price-sensitive. That creates a double pressure. Costs are rising, but the ability to raise prices is limited. And that's where margins start getting squeezed. Now let's talk about production. Fuel doesn't just move products, it powers industries. Agriculture relies on fuel for machinery. Construction relies on fuel for equipment. Manufacturing depends on energy, which is often tied to fuel markets. So when gas prices rise, production costs increase as well. Even businesses that don't think of themselves as fuel-dependent are affected, because fuel is embedded in the system. Now add another layer: logistics companies. For logistics providers, fuel is one of the biggest expenses. And when costs rise, they don't absorb it, they pass it on. Fuel surcharges, additional delivery fees, higher shipping rates, and those costs get passed to businesses, which then get passed to customers. So even if a company doesn't directly use much fuel, it still pays for it indirectly. Now let's talk about small businesses. This is where the impact becomes even more visible. Large corporations have more flexibility. They can negotiate contracts, spread costs across large operations, absorb short-term increases. Small businesses don't have that advantage. They operate on tighter margins. They have less bargaining power, and they feel cost increases much faster. A small retailer, a local restaurant, a delivery-based business, even a modest increase in fuel costs can have a real impact. Higher supplier costs, higher delivery expenses, lower customer spending, all happening at the same time. Now here's another hidden effect: labor. When gas prices rise, commuting becomes more expensive. Employees feel that pressure, and over time, that can translate into higher wage expectations or changes in behavior. People may look for jobs closer to home. Remote work becomes more appealing. Turnover can increase. So businesses may face indirect labor costs linked to fuel prices. Now let's zoom out. What we're really looking at is a chain reaction. Fuel prices rise. Transportation costs increase. Supply chain costs expand. Production costs go up. Logistics fees rise. Consumers spend less. Businesses struggle to pass on costs. Margins get squeezed. And all of this happens step by step across the entire economy. That's why gas prices are so important. They sit at the base of the system. When they move, everything else adjusts. Now here's the key point. The impact is not always immediate. At first, businesses try to absorb the cost. They adjust internally. They delay price increases. But over time, the pressure builds. And eventually, it shows up in higher prices, in reduced services, in tighter margins, in slower growth. Now let's talk about how businesses respond, because they don't just sit back and absorb the impact, they adapt. First, they focus on efficiency, optimizing delivery routes, reducing unnecessary transportation, investing in fuel-efficient systems, because every cost saved matters more. Second, they rethink supply chains, sourcing closer to home, reducing distance, building more regional networks, because shorter supply chains mean less exposure to fuel costs. Third, they adjust pricing strategies, sometimes raising prices, sometimes adding surcharges, sometimes offering smaller portions or packages, all ways to manage rising costs without losing customers. Now think about the long-term impact. If fuel prices remain high or volatile, businesses may permanently change how they operate. More local production, more efficient logistics, more investment in alternative energy. Because reducing dependence on fuel becomes a strategic advantage. Now here's the bigger takeaway. Higher gas prices are not just a temporary inconvenience. They're a systemic force. They affect how goods are made, moved, priced, and sold. They influence consumer behavior. They shape business strategy. And because fuel is so deeply embedded in the economy, almost no business is untouched. So when gas prices rise, it's not just a story about drivers. It's a story about the entire business landscape. And that's why this matters. Because what looks like a small increase at the pump can turn into a much bigger impact everywhere else. And for businesses across America, that impact can't be ignored.